Welcome to the Market Rant. My name is Joe Favi alongside my co-host Tom Canfield. I'm excited for this show. We got two awesome guests
Unbelievable
with us. Let me introduce our first guest is trader extraordinaire, one of the stars of IBD Live, product manager at MarketSmith, one of the star of the investors.com podcast. Men want to be him. Women want to be with him. Trader extraordinaire.
Wait, are we talking about? Wait,
we're talking about you, dude.
we're talking about me.
Right, we're talking about you.
Irusha Peiris, thank you for being here, Irusha.
Great to be here, Joe. Great to be here, Tom.
Awesome. And
when he walks down the street, the women just flock. It is
the other way.
It's amazing.
It's like parting the seas.
This is going to be great. Our other special guest, one of the greatest portfolio managers out there, in my opinion, one of the most under the radar, awesome portfolio managers, who has probably forgot more stuff than I'll ever know in my life. Phenomenal stock picker, market historian. You might also recognize him from the movie The Big Lebowski and for his role in that movie.
The dude who abides.
The one and only Mike Webster. Mike, thank you for being with us.
Hey, thanks for having me.
Awesome, guys. Awesome. All right. So I'm excited for this. Tom, I don't know if you want to start off with just sort of some questions, market process, thoughts on the market. You go ahead and fire up whatever.
Why the fuck do I have to start? Seriously.
Dude, you're the star of the show. You're
the star. I'm the co-host.
Everyone's here because they want to see how many F-bombs you.
That's true.
I was going to try and keep it clean for you guys, and so we're
Zoom has an F-bomb limit, and I set it to 300, so we're good.
Right, yeah. But Fahmy, I already told you I'm baked from today. I had to recover from yesterday. I didn't want to have to talk, and the first thing you say is, Tom, what do you, why don't you start us off?
I'm just trying to include you in here. All right, so guys, I want to know.
So we'll balance it out because
I got to. All right, let's jump in. Let's jump in. I got. We're all arguing. Let's calm down. Deep breath. Okay, I'm opening up a beer. I got the good stuff. I got a million questions. I want to start off with process. I know a lot of people want to know this and ask questions, and I know can be a 3-hour conversation. Just sort of. Let's start with you, Mike. What is your sort of daily, weekly process when you're approaching the markets? Because you do amazing analysis, and people want to know what your process is.
Well, it's been the same for, 20 years now. The bulk of it I do over the weekend. So, I'll run tons and tons of screens. I basically look at everything, things I'm not going to trade, and it gives me a feel for the market. And so that's a starting place. But midweek, you still have to do a ton of screening. And after we do our show in the morning, I screen about 500 stocks, and I go through and create a couple lists that we share with people. And it's really, there's no one screen. Everyone's looking for that holy grail screen, and it doesn't exist. So you have, I've got probably 40, 50 screens essentially that are going into one filter that I'm looking at. So the Growth 250, which I created way back when, that has 30 screens in it. So that's a starting place. Plus I have a bunch of other things, stocks that I'm not going to trade, but I want to look at, like Boeing, for example. We're not going to trade that. You guys might trade it. We can't, because that's not in our wheelhouse. That's not our style.
What do you mean, you guys? What do you mean, you people?
you too.
Like you please.
What do you mean, you people?
Yeah.
You too. If if you want to make like 100%. No. If you want to make 100% in a week,
might be on your Robinhood account. It's really cute what you're doing. I might look at Boeing, but
get your fractional shares.
That's not at all what I meant, and you guys know that. And you're going to get me to cuss, but we're both IBD employees, so we can't.
Our goal is to get you guys to cuss.
Now the game is on.
It's not going to happen. So
I agree with you on the weekend stuff. My question is, do you screen every night, or you're screening during the day, or both?
Oh yeah, during the day, like constantly. While we're doing our show, I'm screening. Second that it's over, I'm screening. Plus, I have a universe list. So, the universe list is now something that, and we're not here to plug anything, but I'm just ask the question.
I don't care.
We have this list that we give out to the people that watch the show, and that's essentially my watch list. And I'm adding to it and subtracting it as soon as the show is over.
Really quick, so people who don't know what the show, it's IBD Live. Tell them just, quick 30 seconds what you guys do in that show.
Irusha, you tell them.
Arusha, go ahead.
And we're not here to plug anything.
I know you're not, but we're talking about.
We're not here to plug anything, but let's talk about what we do.
No, I mean,
Get 2 minutes into it. We've talked about IBD Live.
It's like having an actor on. It's like having an actor on. Like,
own it. Just own it.
All right.
There it is.
There he goes. Pour yourself out. Why not?
Go.
I mean, it's like having an actor on Jimmy Kimmel and like you can't talk about the movie you're plugging.
Yeah,
so
we're not.
Arusha,
but the truth is, neither of us get a penny for the show. So we do it because we love it and we love helping people, just like you guys love what you're doing.
Yeah.
And we don't have agents, so we don't get paid for it.
Well, we do.
Arusha,
Actually, Fami's got an agent. None of us do, though.
Tell us what IBD Live, 30 seconds, what it's all about.
Yeah, IBD Live, for the first hour of every trading day, 4 of us will get on, and we're going to watch the markets with you. We're going to see if any stocks are breaking out, setting up, or look like a couple of Wednesdays ago when the markets were falling apart. Everyone got to see how we were panicking with everyone else, but not necessarily panicking. Honestly, I listen to it every day. I'm only on.
Does anyone get scared? Does anyone cry? Does anyone like run out the building? Is anyone
we hide it. We hide it inside pretty well. You know, we mask our feelings pretty well. But so you get to you get to see how we're reacting. And really, what we've heard is, you know, it's kind of the same approach, regardless if things are going up or down. You're trying to be as methodical as possible.
Okay.
Well, and Joe, I think it's important that we just, for the people that are that are watching this podcast, that they kind of understand, you know, a little bit about the core of IBD and your all's company, and why Joe and I consider you guys such special guests. You know, it's IBD, it's MarketSmith, it's all from the canceling methodology that was created by William O'Neill back in what you guys tell me, the 50s. I don't know.
It was the early 60s. Is really when it kind of started. Yeah.
And it is the Bible for both Joe and I in terms of how we see the market. It's how we have always viewed the market. It's everything that Joe talks about on his videos that he's doing, everything I've ever done as a swing trader, and even now as a day trader. It stems from daily use of this product, and it stems from the whole concept that they represent. Right. So that's why we're tied into these guys. So you understand the connection of why.
I agree 100%. I don't look at this as a plug. We're actually telling you what we're using and what I've been using since it was the printed daily graphs for, you know, we used to get them in the mail. So it's real.
Those are
shit
great,
that we're
man.
using.
Didn't you like the prints?
I used to love that. I used to flip through those pages, and it was.
My grandfather used to get those.
My great grandfather.
Joe, did you know his grandfather?
What? No. So look,
his grandfather and I were 2 years apart in high school. Just so you know, we were 2 years apart. All right, so this is what I'm going to do. I'm
the whole Bill thing. Let's just like summarize it. If people don't even know who Bill is,
go ahead.
He approached the market in a way that we all follow in the building. Whether it's IBD where we work, or William O'Neill where I used to work, or our sister companies, that we just objectively look at the market and just say, okay, you know, what really happened, not what do you think should happen, you know. And it's a lot of what you guys talk about is just objectively and being intellectually honest, which is so hard for so many people to do, and change your mind when the market changes. And that's what I learned from Bill. You know, I used to call him every night for like 15 years on Sunday night with stocks for us to put on our institutional list. In some nights he would just be so bearish. I mean, just the world is coming to an end, you know, let's look for avoid stocks, but they're short stocks, and let's take everything off of our buy list. And then by Tuesday, something happened in the market and he's switching gears. He's calling me up, Mike, you know, we need more stocks on the list. And then I'm scrounging for names, and he's just that flexible. And he's taught all of us, everyone in the building, it just has that mindset of just switch as the market moves, rather than what a lot of Wall Street does is they plant their flag and they're like, I almost cussed. They plant their flag. And
almost we almost got an S-bomb or something. So Tom and I have talked about, like, one of our favorite phrases is don't focus on what you think the market should be doing, focus on what it's actually doing. Mm-hmm. So I think that's kind of what you're saying. And the other one is Stanley Druckenmiller's line of one of his greatest strengths is his ability to change his mind quickly.
Right.
And I think that's what you're getting at, Mike, is you have to be flexible. One, because the markets are moving quickly. And two, I think, unfortunately, because of social media, or because if you have a blog and everyone, and my grandmother has a blog, and they say, okay, I'm bearish. And like you said, on a Sunday, and then something happens, their ego's too big to switch their mind by a Tuesday. But I really don't care. You have to be able to change your mind.
Absolutely. And that's what, it was so wonderful to watch him for all those years do that in real time, because in our institutional sales force, who are having to talk to the Contras of the world and the T Rowe Prices of the world, and they would get flack from a lot of, not from the Contra, but from a lot of the general mutual funds, not anyone in particular, that hey, you're switching. Why did you say this, on Monday? Now you're saying this on Wednesday. And they really came back after a while, after they got it, of, wow, this is great to have this perspective of, changing on a dime versus just saying, oh, I liked it at 100. Now it's at 90. I like it more. Now it's at 70. I like it even more, which a lot of people do. And so it takes a little while of getting used to, but then they come back and and some of our best clients have been with us for decades and decades.
That's awesome. I'm going to pull up just a random chart because, Apple's an asset class by itself. So I might as well pull it up. My question to you, Irusha, is when you pull up a chart, being, the product manager at MarketSmith, when you pull up a chart, what are the first 2 or 3 things on MarketSmith that you're immediately looking at?
I'm looking at the price and volume action first and foremost, right? Because you want to see.
So you're looking like the chart pattern of
exactly
like uptrend, base, all that stuff that it's being built. I'm sorry for my gross lines, but
it's pretty good.
So that's what you're looking at.
I'm looking, and really for me, and you're going to get different answers from whoever you talk with, but I like starting out with the weekly chart first.
Okay, that's interesting. So you're going right to the weekly to get a bigger picture.
Exactly. It just gives a longer term perspective of the chart where it is. And so I'm looking, and the first question that I'm asking myself is, and this is, what Mike's talking about, going through hundreds and hundreds of charts. You want to become efficient at going through tons of charts in a short amount of time, because that's how you stay on top of the market. But the first question I'm asking, just looking at that price and volume action, is this stock buyable or going to be buyable in the next few weeks? And if it is, then I'm going to add it to a smaller list. If it's not, okay, let's just keep moving on. So I want to try to narrow down, like the Girl 250. The Girl 250 is the first list I'll go through on the weekend. I want to take out all the gems out of the Girl 250 that could be actionable in the next couple of weeks, put it in a smaller list. So now I can spend more time looking at the fundamentals on the left-hand side.
If it's near a buy point, that's the first thing you're looking for.
Because you want to spend most of the times on the ones that you have a chance getting into in the near future.
So it literally is the graph and the chart before all the other awesome data on here.
Absolutely.
Same with you,
and that
Mike,
took me years to realize.
Yeah, without a doubt, because that's how you get a feel for the market, is looking at as many charts as possible. And if you get stuck on one, let's say you're looking at Apple, right? And I agree with it. You start with a weekly. If you don't know the stock, you actually start with a monthly to get to the character of the stock. But let's say, we all know Apple.
Looking at a monthly, okay.
Yeah. So when you're looking at this, what you're saying is, okay, what is the character? Has this been, a dog forever? Like, let's pull up GE real quick, just as a comparison. That was, you guys remember back in the 90s that was one of the key stocks, and it's just been terrible ever since.
Yeah, I'll go back and look at this So this is 1980 to 2000 GE.
Yeah, it was like an Apple, right?
Was the blue chip stock of the 80s and 90s. One of them,
Yeah. So that's the first thing that you do, and that's when I would give a stock to Bill, if he didn't know the stock, he would go to a monthly chart, and then right after that, even before a weekly, he would look at the sponsorship and see, who's in there. Do you have the best people out there, like the Fidelities or the T Rows or the MFS Growth or
Okay.
Lord Abbott, all the great people. That's another thing. Then you're looking and saying, well, where are you? Like, this is a piece of junk, right? You're underneath the 200-day, you're underneath, 40-week since it's a weekly, you're bouncing up, you're under $10. So we're just not going to play, that 200-day, that's the black line there.
Right.
And
No
as a
touchy.
general, exactly, no touchy. I like
No
that.
touchy.
So a lot, I mean, this gets to one of my first questions, which I know that, but the answer, it's more, a lot of people are obsessed with cheap stocks because they think of it as, I got to be King Kong and own a lot of shares.
Yeah.
And, we all, come from the same sort of blueprint, but can you explain, let's say you have $5,000 and your goal is to turn it into $6,000. What do you care if you're buying 2 shares of a $2,500 stock or, whatever, 1,000 shares of a $5 stock? Your goal is to turn that into 6,000. But people have this obsession with, I got to own so many shares. And that's why they're obsessed with low price stocks.
They just, don't get it. And at first, when you go through a learning,
every Robinhood trader just turned off this podcast.
95% of our viewers just gave you
but who cares?
No, dude, I'm on with you guys. I'm just
right.
I'm just telling the truth. Look, that you guys tell the truth and curse. I'll tell the truth and not curse. How about that?
Perfect.
Way to be about it.
You want to see, your account grow from, let's say 10,000 to 12,000. So you got a 20% gain. Think of everything in percentage terms. So, who cares if you have to buy a fractional share of Amazon to do it? There's nothing wrong with that. It is not embarrassing. That all came back from back in the day. You guys, when we all started, you had the round lots where you had to buy things in groups of 100, or your commission would go higher. You get the odd lot commission thing going on there. So everyone wanted to trade in.
What are you, 90? I forgot about that.
Yeah, so you don't remember? Dude, I used to pay so much. I remember
odd lots. Yes, you would pay more for odd lots. I forgot about that.
You mean they didn't always trade in decimals?
No, and they were teenies.
There wasn't always just a penny bid offer spread? No?
Yes. No. Wow, I remember when that changed.
Fractions? What are you talking about?
I guess I'm old. Yeah, there were quarters.
I remember teenies and eights. Yeah, I remember,
Yeah. So anyways, to make a long story short, there's something to be said for quality, and that's price. And we'll probably talk about Bill a lot. Back in 15 years ago, he had come up with this simple idea for a list that he would get over the weekend. Before the show, we were talking about printed books, that he would get a printed book with just the highest price stocks in the market. And this is back when stocks were still splitting. Yeah, because he was one of the first to just clue in that the quality stocks, and that was, you remember Priceline was one of the first high price stocks.
Yeah.
Of course you had Berkshire. That's a special situation, but yeah, so it's quality. So I like to, if it's over 100, that's good. If it's under 100, I'm going to investigate it a little bit more.
Yeah, actually, that's funny.
This is the monthly price line that used to be $10 and now is 2,000 or close to it.
So ridiculous. Yeah, the $100 level is that's a big level for me too. If I like to focus on stocks over 100. Now it's funny because that really narrowed it down. Now it seems like so many stocks are over 100, and so you almost have to raise it if it's over 300. Maybe because as we saw with Amazon, it can go from 300-400 up to 2,000. In a short amount of time.
So besides the chart, really quick, because I'll stop sharing this in a second. When you're looking at, I'm pulling up Apple. What else after the chart? What's the next one? Either one of you guys can answer. What's the next thing you're looking at?
The weekly data. If you go over to
weekly, okay.
Yeah, in the left side. So because that has the fundamentals.
I just have this shrunk, but it's down here in the bottom. There's 8 quarters, right?
Yeah. Okay. So that look, I like Apple a lot. I think is one of the best companies, around, but those are mediocre growth numbers. And that just comes with a law of large numbers.
Again, you just offended the entire, no kidding. The largest.
Who can I not offend?
The largest
AC/DC fans are the only ones that are still with me.
The largest, held stock or what, most widely held. Anyway, I'm just giving you a hard time, but go ahead. So you look at the weekly.
Yeah, you're looking at the quarterly numbers. You're looking at the annual numbers, which on this one is impressive. Up in the top right, where it starts with the 2013 year, top left. I'm still learning my left from right.
Oh,
so
here, this,
that,
you're looking at that as well. Okay.
Oh, in a big way. So, you want at least 3 years of increasing earnings. That's kind of a standard can slim, thing. The more in a row that are increasing each year, the better. And if you have a decrease, it's a defect. And what I like to do with each stock is just rate it. And you start by looking for defects and start at an A and, bring it down and back up depending on what you see.
Okay. And then on the daily chart, relative strength, I know.
Yeah, relative strength is the third one, I would say.
O'Neill,
but I would look on the weekly first.
And it's a relative strength really line. Hardcore. Yeah. I know Scott O'Neill talked about weeklies a lot, and he influenced me a lot with weeklies.
It's been drilled into our heads.
You guys really look at it because the average holding period used to be like 7 years. Now it's 7 seconds. So
it seems like it. Yeah.
So no one in their right mind looks at a weekly anymore. But so relative strength. I think O'Neill says in his book he won't touch anything 80 or below. Is that true?
Well, let me just answer. Mike can answer the 80, the 80 rating for relative strength. The one that, and I was a long time customer like you guys before, and then I started working at IBD and MarketSmith. I learned during that time how important that relative strength line is. That relative strength line is gold.
The line is more important than the number.
Yes. The line, the angle of the line. Scott St. Clair, is the one who really made that popular, at least for me.
Here.
Yes. Okay. If it's continuing to outperform the market, there's something going on there, and so you want to keep it on one of those short lists to really try to get in the next time it gives you that opportunity.
Okay. And then the 80 or 90, like my cutoff is about 90 personally, but whatever. Who the hell am I? But is 80 like a? Is it a hardcore number or?
No, that's kind of squishy. The higher the better. 87. Yeah, 87 is kind of where a lot of our studies that we did, I did this massive, gigantic study and came up with 87. Bill picked 87 out randomly. Not randomly, but that's how smart he is.
His intuition.
That he just realized over decades and decades of looking at these that 87 was the key, not 88, not 86. I did this massive computer-based study on every stock since 1962 and came up with the same figure. So if that clues you in on his genius, but that's an average.
87 or above is the sort of cutoff point.
And the higher the better. And I use the, it doesn't show up on the chart, but you can screen for it, is the 3-month RS. And I'll set that to 70 or higher.
Oh, okay. Okay. There's so much stuff I know you can screen.
Where would one find the 3-month RS?
What?
Where would one find the 3-month RS in MarketSmith? This is a new concept for me.
There are a couple of ways.
18 years later.
Well, you can screen for it.
For people that don't know, before we started recording, like they showed Tom and I shit we didn't even know existed on here.
Unbelievable.
I'm like, where are you? Well, it's like Batman. Where does he get all these
like
wonderful
a first grader.
It's
like, this is what happened.
I'm going to stop sharing for a second.
In the late 90s, right, we had the huge move up, and you had Qualcomm that had the biggest move in 1990.
Oh, yeah.
And then it came crashing down. And for the longest time, it still had a relative strength of 99 because that's over a 12-month period of time, right? And it just ranks it. It says versus every stock in the database, what is, how does it rank? And the top 1% get 99, the bottom get 1. Well, if you've run up 3,000% and you've come 70% off your highs, you're still up way more than everything else.
Right.
So I came up with a 3-month RS and a 6-month RS, and it's more exponentially weighted. So the most recent time frame, even in that 3-month, is more meaningful. But you don't want it too high because then the stock is going to be extended. So kind of the sweet spot is 70 for your screening.
Can I come up with a 2-month RS and beat you to it? Kind of like 8-minute abs and 7-minute abs. Can I come up with like 2 months and just beat you to it?
You guys are making this so hard.
No, that actually makes sense from what you're saying. And Qualcomm come crashing down, it's still up 1,000%.
Yeah, Webster looks at 800 charts a night. Like, who fucking does that?
He does it during the day. While you're sleeping, he's looking at charts.
Yeah.
But the cool thing is the program.
It's like Rocky 3, you know, when Clubber Lang was, you know, working out in the basement, you know, and meanwhile Rocky's, you know, he was just hanging out, having some beers and stuff like that. What happened the first time those guys met? You know, Clubber Lang beat the crap out of him.
Yeah,
right?
There you go.
He almost swore. He almost swore.
That counts.
Exactly like that. Does that
That's
count?
a 4-letter word.
Oh yeah, that's right.
Yeah, I know.
I wouldn't want to be you.
Okay, but to be fair, what's cool about the product, though, not to be a shill here or anything, but is there's so many different within the overall arching philosophy. Like, I use the product completely different. I screen totally different. All the stuff that you guys are talking about, I'm sitting here going, I don't do that. I don't do that. I have 8 scans. I use those 8 scans that I tailored, and it ends up making a list of about 75 to 90 stocks that I set every week, and that's it. I will not look at another stock unless a stock breaks out. So I have a breakout scan that I look at 3 times a day to see if there's new ads, and that's the only thing that I do, and everything comes from those 90 stocks. And if those scans can't produce winners that can make me a living, then my scans have to get better. But I don't like looking at 400 to 600 stocks or constantly. It's just, I've scaled it down to such a refined. So I don't look at anything that's under the 50-day moving average.
And while you said that, Webster's been screening and he found 3 stocks for tomorrow while you're saying that. So,
but it's
no,
like,
I'm not.
Like,
I turned off my other monitor.
So it's just.
He's like, I don't want to listen to this. I just want to screen. I'm kidding.
Tom, you talk about a very good concept there, though.
Because
I use it differently too. I use it. Go ahead, Irusha.
I've referred to what I've done as it's kind of like CanSlim on steroids, because it's like, I don't want to see a stock that doesn't have at least 30% earnings in the last quarter. I don't want to see a stock that doesn't have at least 15% increase in sales. And then I've got other scans where it's like, I just want to see the stocks that have triple-digit earnings growth the last 2 quarters. Who are those companies? And I'll be damned if they're not the companies that are just blowing it out right now. And so you're trading
the absolute best.
And that's
I want the best of the best.
You're drafting. You're an NFL
growth managers
NFL owner drafting
over
only
each other
from
to get
the
stock.
SEC.
But that's a really important concept.
I don't give a shit about the rest of them.
Yeah, and that's perfect, because and this is what I tell a lot of people is, you learn the larger concepts of CanSlim, then make it your own.
Right.
You have to fit it to your own personality. So even in-house, Mike and I trade completely differently. So sometimes we'll actually, a lot of times we'll be in the same stocks. We just might be in at different times,
right?
Or just getting different points and things like that.
Or one's long and one's short.
that doesn't happen.
Usually it isn't. No, usually
I'm kidding.
But the thing is, you got to figure out a way to fit it to your personality and make it work for you. Yeah. So we're all completely different in-house, and we're all studying the same system.
Yeah,
right.
No, it's a
and
great.
That's what's really cool is you can tweak it and tailor it to fit.
Yeah, yours is laser focused on the absolute best, and you know what? You're starting with the absolute best you can find. I mean,
and I'm still using it as a day trader. I still use that list to be able to evaluate what's really going on in the market, because if those stocks are still going, the market's okay. I don't care what the indexes say. And if those stocks start to peter out, which typically happens before the market peters out.
Mm-hmm.
Yep.
It's always been the very best tell for me. So, and it's rarely ever led me astray. So and you do that over years. You just kind of formulate it. Now I don't change them at all.
Yeah.
And it's.
So
I think that's great, Tom, that you have that system down, because what it does is it gives you a unique list. And what I got from that was the knowing when the market is topping before you see it in the indexes themselves. And that's when the leading stocks start rolling or they start acting funny. And if you have just a unique list that you're looking at, whether that's your screens, the top 50 by market cap of the S&P 500 or the NASDAQ, you pick it. It doesn't matter. Yeah. Pick the same list of leading stocks, watch them, and that'll give you a clue. And I'll tell you, there were many times where, when we weren't sure about the market, Bill would have, just ask me, go through the leading stocks, tell me how many have completely topped. And then he would ask another PM that, and another PM, and then he would come back with the consensus that, okay, Mike thinks this, Charles thinks this, whoever, and then that would give us another sense of, a feel like what you're talking for. So that's very important.
So the leaders supposedly top 2 to 3 months before the market tops. Is that still sort of like a Qualcomm topped in January of 2000 before March, April? Is that like a consistent thing or no?
No,
I don't think so. I remember with my list, like going back to 2018, like in October of 2018, the market started to tank and it went, and everybody remembers that. And I was so thankful for this system because I watched all the stocks that I keep track of in September, just starting to let go. The indexes just stayed. And every single one of the leaders was duck and run. And they were all failing. And all of a sudden I realized, shit, this isn't good. Because suddenly I had nothing to buy because nothing looked good anymore. Yet the markets were still climbing. And so I remember tweeting out at one point, like on September 29th, I said, I'm done, I'm in cash. And it was like October 2nd, bam, or whatever it was. And then it went straight down and it was unbelievable. But so it was the stocks failing prior to the market, the leaders failing prior to the indexes failing. It was it was best tell ever.
And Mike, so that whole 2 to 3 months, so I agree with Tom, they tend to fail before the market does. Is there any, based on your studies, like rough time frame or no?
No, well, it also depends. So if you think about the March of 2000, that was unique because you had the Qualcomm top right at the beginning, right at the very end of 99, the beginning of January, and that was the stock to trade during that time. And so that fell, and then you had and the market should have rolled at that point, but it didn't. It had one last squeeze in there. And that's what was how you guys remember in 98, 99.
But even Dell topped in February of 99, a full year before the market topped. And that was also a monster that split every year like Cisco.
And that's why people like the cheap stocks. Going back to that is back in the day, there were the splits. You remember the services that they had where,
the split. I remember subscribing to the split report and playing run-ups into splits. Oh, yeah. Cisco and Dell would split every year like clockwork.
Yeah, but going to your question, no, that has changed, and that was unique with a calendar change and then also the tail end of a bubble. And there was still a ton of money to be made from January to March 10th of that year. And if you remember that what happened is the NASDAQ fell, but they were still trying to support the Dow stocks and the S&P stocks and those didn't roll over until what it was like maybe August September of that year, because they were trying to do this rotation into them as they were just unloading all the tech.
Because the NASDAQ dropped like 37% in 15 days or something, and the S&P didn't even drop it like a third of that, right?
Well, but it also didn't run up with it either. I mean, it was true. That was during the time when the term bifurcated just absolutely drove me nuts because they said it every single day. Bob Pisani would say that, we got ourselves a bifurcated market again today, folks. Like, fuck off. Well, it's like I hated that word.
Well, Bob Pisani, he has always been wrong about volume, the way he looks at it versus the four of us.
Volume's anemic today. That was his clip. Volume's anemic.
But it's like huge versus the prior day. And I don't know what he was using. But now that I see him on TV and he's got cool music posters behind him now, I'm a fan of him. But I didn't like him for 20 years.
Much more respect let me get a Zeppelin poster so Mike will like me.
But wait, to answer your question, in 2007, it was about 5 days or so before the top. What was it, like the October 31st?
Halloween.
Yeah, the Halloween.
Where if you
were starting to top.
If you weren't trading Google, Apple, or RIM, like why come to work for like 3 months? Because they just
Baidu,
those are the only ones going up.
Oh, that's right, Baidu.
That's right.
Yeah.
And then so they topped. So the whole point though is the leaders top, whether it's a few days or a few months, but keep an eye on the leaders to roll over before the market.
Well, leaders lead on the way up and they lead on the way down. Right. If I start seeing some of the stocks that have done so well, when they get crushed, a lot of times it might be on an earnings report or something like that, but they just get a few of them just get taken out. All of a sudden, a warning goes up and goes, they've taken out a few. Are there enough leaders to continue to move the market higher? Sometimes there are, but kind of like what Tom was talking about in 2018, things where I was doing okay, and all of a sudden, I think like Roku and Match, all of a sudden they just started getting clobbered.
Just imploded.
Yeah.
No, Tom's right about that.
Yeah. Wake up. Right.
And to add on to Tom being right, Tom, you'll like this because it's Tom being right.
It's really important for you guys to focus on that, I think.
Yeah. You were so right about not finding good merchandise. Like you can find
Nothing.
junk, right? But not anything quality. You're like, oh, this, $5 stock is moving, or this stock that has no earnings, no story, no monthly chart, no weekly chart, and it's set up. But you're right. The screens that you have, nothing's going to be there.
Right. It's just my screens don't allow me to see that stuff. And
the Growth through 50 is kind of like that, right?
Yeah,
where it'll expand and contract to a point.
Yep.
And I found that, you guys can correct me if I'm wrong, but it's like each cycle, first of all, each cycle the leaders are different. Not completely different, but the mix of who the leaders are and what the key growth sectors are that are leading change kind of from bull phase to bull phase and whatever. And I find that there's really only about 25 to 40 stocks that really matter. And everything else is periphery. But the core key leading stocks, there's really not more than 25 to 40 of them ever. And so that's when those fail, I know it's time to get out, at least the way that I've done it. I don't know how many stocks. I mean, I know you follow a lot more stocks than that to try and get a feel for the market, but at the end of the day, even like now, I mean, I could list 15 to 20 stocks that are really, really key that you can tell are really getting accumulated.
You're basically saying focus on the best merchandise and the leaders.
And it's when those fail that you go, okay, time to duck and run.
Yeah.
Right.
Yep.
So I have like 7 questions here. We haven't even got to one of them.
Sorry, man.
No, I love this. I can listen to this all day.
Listen,
no more
we're still under
plugging
30
our
minutes.
stuff because that was not the intent of this. So no more talking about our product.
No, we're still going to talk about your product. We're not plugging
right.
We're not plugging anything. We've mentioned Robinhood. We've mentioned the airlines, so we keep those people happy. The number one question I think I get the most is how can you be so smart and so good looking at the same time? No, the number one question.
I never got that before.
The number one
He
question
was talking to me.
On position size. I say the most common question I get is on position size. People want to know XYZ stock, Tom, it's setting up on your list, or I like something, I post a chart. What should I go in 2% of my account, 5%, 10, what is a guideline so someone can use, and the number of stocks they should be holding?
That's a huge thing. Irusha, why don't you take it first, because we do that differently now.
Yeah, well, I'll go from the traditional kind of can slim, and so with the traditional, the ideal kind of portfolio that you want to eventually get to is 5 stocks, right? You have 20% in each stock. Now, at the beginning of a bull market, you just don't pick 5 stocks and these are my 5 stocks and good luck. A lot of times, from my experience, I'll start out with 10 stocks or maybe 12 stocks even, because there are numbers starting to set up, and then one by one they start to go maybe in the first few weeks. So you're ideally putting 10% positions in each of them, and then you let the market tell you what to do. So if you have 10% in 10 stocks, 5 of them are probably going to go sideways or start selling off, or maybe even more than that. A few of them will work immediately, and you're going to be up on them. And that's where you're going to start pyramiding into. You want to start force feeding into those best ones, because the market's saying, hey, you want to put more money because those ones are actually working. Others are agreeing with you on that, and that's how it's pushing up the market.
So you would drop one of those 10 and then make one a 20% position.
Yeah, well, I mean, 3 or 4 are going to fail probably pretty quickly. Yeah. So they make it easy. They're going to force you out, right? If you're respecting stop losses, things like that, they're going to force you out. The hard ones, and kind of like AMD, AMD's been a hard one because it's NVIDIA and AMD both kind of out of this recent rally, they both started working, and I had both of them. Then all of a sudden, AMD just stopped doing, just didn't do anything, right? NVIDIA is acting like a leader still, and eventually AMD just wore me out, and I just had to cut and run, even though from a larger perspective, it was still fine. but I had to free that money up to put in his other stocks that were working. So you're kind of letting the market tell you what to do, but if the rally lasts long enough, now you have the chance to build it into 20% positions.
Okay.
So that's kind of the traditional way. Mike, you can kind of explain another way, or how leaderboard does it too. Or...
Well, look, there's lots of ways to do it. This is a great question, and I think really the best way to do it is how you feel comfortable as a person. And there was a time where I felt comfortable doing it differently, and really being around Bill so much. Anyone who knows his story, he made his money in focusing in on one stock and being 200% long that stock, like full margin for a move. And there's no one that can pick stocks like him. Irusha can't do it. I can't do it. I guarantee you two can't do it. I've never met another person that could do it the way he could. So he could get away with that. And he didn't just put it all in at once. He would do it slowly over time. And he would always, I shared an office with him for a couple of years. And many times I'd hear him, say, buy me 100 shares. And I'm thinking, why are you buying 100 shares? Like, you got your account's this big. But it was just gradual little bits along the way, always on up days, never on down days. And so all of us at the firm, we kind of got that was our, goal, to try to be like Bill. And, back in the 04 to 06 timeframe, we would all pile into basically two names. And when Apple and Google,
Hansen and Taser.
no, I wish Taser. That's a story for a different day. But
okay.
It was Apple and Google, and all of us would have I had like 80% of the account in Google and 120% in Apple, and we lived to see the end of that without blowing up. But every night I went home thinking, geez, Steve Jobs is going to go down in a plane accident. Like, what type of risk am I taking? So now I've kind of gone the other way. And now I'm like an accordion, and I look at three different things. How is the market doing? And try to grade it, A to C or A to F. How am I doing? A to F. And how is the stock that I'm looking at A to F? And so that will, if they're all A's, then I might, do it one way. And if it's all C's, I'm going to do it a different way. So I'm an accordion. I'll have 30, 40 stocks sometimes. I'll have 8 stocks. And it just depends on how I'm doing. If I'm in sync, I want bigger positions. If I'm out of sync, I will have more positions because I'm just reducing my risk that way. That is not the way Bill would ever operate, and that's not within his guidelines. That's way off the reservation, but I feel comfortable with it. So
I think that methodology and that thought process is a lot more consistent with the everyday man that's trying to do this, right, though, because Bill was unique, super unique, which you've pointed out, and there are so many different factors that are playing into what we do, into how we feel as people. I do the same thing. It sways my position sizing actually more than the number of stocks that I'm handling and whatever, in terms of whether I feel like I'm in sync or I'm not in sync and different things like that. So I think that's helpful because so many people have, Joe, you and I were just talking about it earlier today, about trying to get our head around how exactly did Bill do this. And I think a lot of it is just,
he's a genius.
He's a genius, and his unique personality and his profile, his makeup allowed him to be able to trade like that.
Well, and also think
about, I couldn't do that. There's no way I could do that.
Right.
It's just, you have to tailor it to what lets you sleep at night.
Yeah. And also think for Bill O'Neill, no one has studied growth stocks more than Bill O'Neill in the history of the stock market. That was his obsession for 50 plus years, right? And it's so obsessed that he developed all these tools to help him analyze the stocks even better. All these tools that were created to help him analyze the stocks. It wasn't necessary. And then it's like, oh, this is cool. Let's provide it for customers and all that stuff. But yeah, so if you've studied it that much, yeah, in my opinion, you've earned the right to, that is the leading stock in the market. I'm going to slowly, even then he's still slowly built into, a large position if the market kept saying put more money in put more money. It's just the
So,
listening of the market. That's really the biggest
a
thing.
lot of people have asked me this question, and I don't know the answer. They say, okay, you look in the beginning of the book, How to Make Money in Stocks, and it shows you these monster winners, 500, 1,000%. And they get the illusion of that's what they have to try to do, or that's what O'Neill did. And then another part of the book says, you know, buy 3 stocks. If you make 20% on one, stop yourself out at 7 on the other 2, you make money. So the question they ask me is, what should I be doing? Should I be going for that swing, you know, 20% gain, 7% loss, or should I be putting more in and going for those home runs? And I tell them do whatever works for you, because I don't know, but do you get that? Like people asking, like
all the time.
Like was it? Did he really put like, you know, a whole bunch of money in 2 stocks and that's it, or you know, did he take profits at 20% and stuff? I mean,
he did it both. He did it both ways, and it would depend. You know, he was always searching for the best stock. And I remember the first time witnessing him getting really gung ho in a stock, and it was Corning, and it was after the market topped in March of 2000. And if you guys remember, we had that rally that was like probably
July,
May,
August of
May, June, that, and it was ripping up, and even though we all probably thought, okay, this is a bubble that's burst, there were a lot of stocks that still looked good, and they were still trying to, you know, keep the Dow up and the S&P up so they could dump all their stocks like we talked about. So Corning was, you know, had changed their business model, and they were fiber and all this stuff, and he was gung-ho. He was all in it. But what happened is, so I don't know how much he had, but I would guess it was over 100%. As soon as the stock started faltering, he got out. So we could fall in love, or he could fall in love with the stock, but have a, you know, kind of a line in the sand there for that one, and then go on to trading more 20% gains, you know, in 2003, you know, at the beginning. But he also was building eBay in 2002, and that built into a big position. So he had this monster position in eBay, and so he would just take little trades on other ones as he's piling in over time.
Yeah,
so
but
the direct answer is he does a little bit of both then? He does a little bit of short-term and long-term?
A lot of long-term, some short-term, to really find what that right one was. So you got to kiss a lot of frogs type of thing, you know. So he had this has this feel for, you know, what is that true leader. The way I approach it is a blended approach. I do swing trading and I do position trading, and because there's something to be said for swing trading of just locking it in and moving to the next one, and I like that.
Which is how I always did it. I mean, your swing service that you're in charge of was very similar to the way that I used to trade my swing stocks all the time. Capture the explosion, get out, move on. Yeah. Just keep cycling your money through explosion when the market was hot.
And
keep the money moving.
Yeah, I made a cut off Irusha. He was going to say something.
Yeah, I'm sorry.
No, it's about big winners. You were going to add to how he trades.
Well, yeah, because people like even in seminars, people would ask Bill this question, and I think the best answer I've heard, or that made the most sense for most people, is for every big winning stock that you have, you should have taken 3 other stocks at 20% gains, meaning take most of your gains at 20% when you have them, lock in your gains when you can, because not every stock is going to be a big winner. When you start this, you know, every stock I bought, I thought was going to be a big winner. Wow, it came through the IBD screens. It's breaking out of a cup with a handle, right? Yeah, exactly.
Yeah.
And then it would go up 20-something%, 30%, and then come all the way back or whatever. So it took me years, but I learned the hard way. I like to take those profits into strength. But if I really like a stock, I'm going to hold some of it. So if I'm up 20-something% and I think this could be a game-changing stock, I might sell a third of it or maybe a half of it, and then I'll hold that core position. Yeah, and if it pulls back, now I can add back to it. But then, you know, it's on my radar. A lot of stocks, I'm locking those gains too.
Okay. This other question I have is, Tom and I have talked about this before, is we've noticed that breakouts used to happen on no news a lot more frequently than now. And what I mean was, I don't know, the bulk of my trading, like, let's just say whatever, 98 to even up to 2010, maybe 2015, I would screen and I would trade, and out of nowhere, stocks A, B, and C would break out on the day, and you'd get these explosive moves on no news.
With huge volume.
With huge volume. Like a nice 3 to 5 day, 10 to 20% pop.
Boom.
And then my friend is screening. I'm trading A, B, and C. He's trading D, E, and F. He's like, oh, did you see these? And I was like, oh, I didn't even see them. He would trade 3 others that break out. And then on my list on my screens, it'd be X, Y, and Z. I'm like, oh, geez, I didn't even see these popping. So they'd be happening all over the place. And correct me if I'm wrong, my observations are either earnings are causing these breakouts or they're not doing what they used to do as far as tape reading. Have you noticed that?
Well, yeah. Well, it's Reg FD, and we talk about it a lot. Irusha and I talk about it a lot. Is that unintended consequence of the government stepping in and trying to help a situation. So, if you step back from what chart reading is chart reading is just interpreting, the fear, greed, and hope, right? That's what we do. That's what the 4 of us do. We're trying to say, who's freaking out and who's getting greedy, and you're looking at the chart for those clues. Well, back in the day, the big funds would get a wink and a nod from the CEO and the CFO of, hey, we're going to hit our numbers. We're not going to hit our numbers. So our job was just to read into that and read into the chart. And so it would act naturally. And that's another reason why I'm spreading out more, is because before you could read it in the chart. We didn't have gap downs back in the 90s. It was very rare to have that, or even, until really Reg FD was really, moving. And now 4 times a year, the companies give this information. All the analysts put in their little spreadsheets of this is what it's worth now, and it immediately tags up to that level or down to that level. And it puts all of us in a position of, well, in between those, 13-week time frames, we really have to do our work because, that information isn't out there. That's my take, Irusha.
Yeah, no, the earnings reports, earnings reactions have just become incredibly important. Every quarter, the way I look at it is this is my opportunity to bring new names on the list, because the market is gonna, with these extreme reactions, it's like, hey, consider these names. You might not necessarily have to buy it on the earnings gaps and all that kind of stuff, but put it on the watch list, see if it can set up something else, maybe a little bit shorter term, like a 3 weeks tight or something like that.
Yeah.
So, I mean, I think this past earnings season was probably the kindest that I've ever seen. Everything was acting well. But you had a number of them, and like Twilio, I own Twilio, Mercado Libre is one. They were all like jumping up on like one day, but there have been a ton of earnings gaps.
I want to share my screen to show you a perfect example of what I'm talking about. Like I'm pulling up ZS from just 2 weeks ago.
Yeah, Zscaler is another one. Yeah.
So Zscaler finishes, the IPO base, whatever, and then it has a handle here.
Yeah.
And it was the earnings that caused it to go from 75 to 100. What I'm saying is, in the old days, is that I felt like you could buy this. It's setting up. You buy it at 75. It pops to 78. You add more like intraday in the afternoon, and then
breaks through 80.
It would do full. This. It would do this move without the earnings, and you could get that. Stock go from 80 to 100.
Yeah. Earnings were a month away. They were the second
there was no news. Maybe an upgrade, but no news, and this would just happen. And now I'm feeling that. And there's been flavors of this in the last 5 years, but I feel like this hasn't happened since fall of 2010 personally.
No,
but
it's been bottled up, right? I mean, because of the Reg FD, and it got more extreme because in 2010 with all this other kind of stuff that's going on.
I was just going to say the move in Netflix and Amazon, it was on, what was it, April 13th or whatever, where they went 4 straight days up with huge volume, was like a huge light bulb for me, because it's like, that's the first time I've seen that kind of price action in years.
Yeah.
I can't remember what
breaking out on no news. That's what
they broke out. They exploded on no news. 4 straight days. The follow through day was like on the 6th or something. This was a week later, and 2 big companies, and they both just launched.
Yeah. And that was before their earnings.
Launched, and it was like a 4-day deal. And it's like, that was for me. That was like something's different here.
They used to happen all the time. Chipotle did that in 2010, coming off that fall through day, September 1st, and it's set up. It went from 100 to 240, just stair stepped and just kept breaking out and through a couple tight.
Well, because more information about their earnings report, stuff like that, how well their business was doing, was leaked out before, right? So it would just kind of filter through, especially like Boston, all the mutual fund companies and all that stuff. And so they're like, hey, buy more, right? So they were getting ahead of the earnings, which was not, for chart readers, that was beautiful. So we're all kind of screwed because of that. But you just have to adapt.
Oh, now all of Robinhood is left. They were coming back.
I have a theory that weekly options also has something to do with this.
Sure, yeah.
Where I think in the old school days, every third Friday of every month was just a regular options expiration. But my theory, which again, I don't know, it's just a stupid theory I have, is that the market makers maybe have to contain these breakouts because of the implied vol for the week or whatever. So maybe
open interest strikes and all that
and it
stuff.
Used to be
holding
10,
stocks back because they're loaded
exactly.
short
because
they're the net sellers of all that stuff. And
they have to keep the stocks down because of that open interest. Exactly. Yeah. And that's my theory as to why, it used to be 10, 20, 40 stocks. Now every single stock, it seems like, has weeklies. So that's what's keeping this muted. It's just a theory I have. I don't know how to even test it.
That is interesting though. Yeah.
I think that makes a lot. I think that makes a lot of sense. And the more some people want to like restrict things like that, but the more ways that people have to play without restriction, the better off it is. It's just like every once in a while people are like, oh, when the market's coming down, don't let people short. No, I don't short, but I want people to short because it helps balance out the market, just like what you're talking about with the weeklies.
Yeah. No, that's a great point. I didn't think of the Reg FD thing. One other question I have, I'll go back to MarketSmith because this is...
I got to go in like 5 minutes though, Joe, but I can click off and you guys can keep going.
Okay. All right. That's cool. A question I have for you guys is, okay, you look at the daily charts I pulled up the NASDAQ to count distribution days, but you guys alluded to this earlier, is looking at weekly charts to get the bigger picture. So
not for the market.
Not for the market?
Right. Yeah.
Or for the market?
Not for the market. I mean, you still look at the weeklies for the market, but the bulk of it you do with daily.
Oh, okay. Because my question to you was, let's say last week there's a distribution day here, right? So there's a distribution day on that big volume. But then when you go to the weekly and the weekly chart shows an accumulation week, do you look at it that way or no?
Look, the distribution is not what it used to be, and volume isn't what it used to be, and especially now that you have all this, you keep alluding to Robinhood, and you've got all these, cheap stocks that have tons of number of shares traded each day, but it's not dollar volume, right? It's not the dollar volume that's moving in there, or out of there. So I don't think you can look at distribution the same way. So right now I'm in the middle of a study with a couple of buddies at work for dollar volume to use in replacement of standard volume for distribution.
Oh, interesting.
We're still working on that because just like what you said, it's a theory. And what Bill would teach is you have an idea, test it out, see if you're right. But I don't look at distribution the way I used to, just because the number of shares so easily manipulated, where if you look at an Amazon that's $2,500 or some piece of junk, or like GE at $8, how much money is flowing through those.
So Hertz at $1 in the last couple of weeks, and they're trading tens of millions of shares.
They're churning 100 million shares sometimes on stocks that have 10 million in
because we've had 3 days in a row over 6 billion shares.
Yeah,
3 days in a row over 6 billion shares on the NASDAQ. It's never happened. So maybe I see what you're saying. It might be skewed by those cheaper stocks.
And it's with stocks that have nothing to do with the indexes.
Yeah.
I
want to go after 2008, 2009, that all kind of was tilted a little bit, right?
Yeah,
like I remember 2004, 2005. It was like clockwork. You get 5-6 distribution days. Yeah, it was all stocks, leading stocks start falling apart, things like that. But I'm with Tom here. It's like you're just and the rest of you guys, leading stocks. Keep an eye on those. That's your universe. Is the environment there to reward leading stocks or not? Right. So that I mainly focus on that, and then I'll just take a quick look at the distribution days. But I don't study it as much, the overall indexes, as much as I used to. I just laser focus on the leading stocks.
I'm learning. Listening to you guys. I love this. Hercules. I love this stuff. Mike,
well, let's
you're
go over
going to pull up some charts.
Stock. Yeah,
Go ahead.
well,
You want to pull up your thing?
I want to see what you guys think of it.
Who cares what I think? I want to know what you're thinking.
I want to see what
when you
Tom
got Michael
thinks about
Jordan in the room, why are you giving me the ball? I'm passing you the ball.
I'll be Scottie
Pull up
Pippen.
any stock you want. Let's talk about it.
I'll be Scottie Pippen. That's funny.
I get
Mike,
screwed over by the contract.
go ahead. You want to pull up your chart?
No. You pull up a chart. Pull up any chart you want to talk about. Let's do it, man. This is fun.
Man, this is there's so much pressure. I'm like sweating over here.
Tom, let's go over some of your 75 that you have.
Oh, my 75.
You want to pull up charts or just give them to me, Tom? I don't care. I mean,
yeah.
Put up
look, I've talked about 3 personally: NVIDIA, Netflix, and Amazon.
Stay right there, because NVIDIA is one of my, is one I'm very focused on.
The reason what NVIDIA going to weekly, NVIDIA, Amazon, and Netflix were all basically in 2 to 3 year bases and came out of them. NVIDIA, coming to bring it down to the daily, right around here, it got tight in this handle here. Mm-hmm. And it's a position I put on. I still own, full disclosure, and it's acting great. And the whole
and
concept,
it's tightening up right now.
It's running up, and you got a little tight range here.
A little shakeout move, but look at if you go back, you got the last 2 quarters, triple-digit earnings growth, over 30% in sales, over 30% up in sales.
And that's why they show up on your screen.
That's why they show up on mine. And that's just like, for me, those last 2 quarters, it's everything. Now, flip over to the weekly, and it won't show it for NVIDIA because it's already a well-owned stock. But if you go to where number of funds area, but it shows what I want to see. I love seeing those 4 numbers getting bigger.
Right here, these 4. Yeah.
And
right
preferably, I like to find stocks that aren't necessarily like NVIDIA. For the way that I used to do things was too big of a stock. It's a phenomenal stock that I consider and I try and trade every day or as much as I can as a day trader. But I like to see, I was more into discovery stocks. So like EVER, put that one up. I don't know. I just have it written down.
Yeah.
Okay.
This one had so much accumulation on the weekly chart. This was like footprints when it was $5. Every single monster.
Okay. Now this is what I would call a discovery stock, because look, it's like funds are just discovering it. Look, 76, 120, 193, 228. It's just a baby. 17.2 million shares out in float, only 27 million outstanding.
Yeah, it was just
these guys to get stock,
a little billion market cap.
They're gonna fall over each other because you've got a company that's growing. Look at the sales growth. Like, that's the stuff that gets me really excited. And then all of a sudden, if it's supported by these explosive volume moves, I'm pointing to a chart you can't even see. That's what tells me that the thing's in play. And so that's a key stock on my list that I'm watching.
Great earnings, gap up. And then, it was like after the fall through day, held up above its 50-day and then just consolidates. One thing I've also noticed is right before stocks or the market take off, they just love to screw the weak hands and shake people out.
Yep.
Yeah.
Before Brexit, when I say just stocks and the market, so Brexit, early July of 16, we have that sort of bear market between mid 15 and mid 16.
And stealth bear market.
Stealth bear market. The SMH is setting up beautifully. And right before I'm like, oh, we're ready for a big move, you have that Brexit to just shake everybody out and then off to the races. So the analogy here was EVER. You have a little tight handle or 2-3 week consolidation. It goes down to just blow through every monkey who has to stop at the low of that range, comes all the way back up, and then
shake
just
the tree, baby.
Was that May 27th?
Looks like it.
Close
to
because that happened like in every stock.
May
27th. And that was one of those. Mike always talks about this on IBD Live. The tells, right? The leaders gave another card out. They revealed another card showing you had all these huge upside reversals right there. And so, this is another perfect example.
That was a massive test. Let's go back to the NVIDIA, because I have a position. I think we all own it. Is one of the leaders there.
I do not own it.
Okay. Well, you're going to own it tomorrow, I know.
Correct.
You're going to trade it. So, and this was what you look for with the tells is, does a big, the EVER, I've traded that too, but it's, much thinner. So it's it trades different. You expect something different from an NVIDIA than an EVER. Not better or worse, just different. And so this one should respect moving averages more because there's more hands in there. Notice that green line, which is the 21-day, never a 20-day, a 21-day.
I have to cut you off because that's another question I get. People always ask me, because I just say 20. People have asked me 20 versus 21 and exponential versus simple. And what's your answer to that, please?
21 exponential. I did a big study way back when, and if you don't like it, do whatever you want. But
no, I don't like it. I just have to change all my damn screens right now.
No, I'm not saying you. I mean people.
No, please.
In general.
So go ahead.
I don't like it, Mike.
Well,
because I know that's the number of.
Mike, I would never say that to you.
I know that's the number of days.
I like you, Tom. So
go ahead.
There's a Fibonacci thing. There's and I just tested them all out. There's not much of a difference between a 20, 21, and a 22, right? And so you kind of want to fall with a Fibonacci number if you can. There is something to that, but also when you're looking for a shorter term moving average, you want to go with exponential always because it's tighter, unless you're using a 10-day, which I don't use, but I used to, and I know a lot of people use it.
I do use the 10, and people ask me the difference between the 9 and the 10, and I was like,
9's a fib.
So
anyway, so go ahead. So,
with
21 exponential.
With the 21 exponential, I started using this after a big study that I did late in the 90s, and before I didn't know anyone who was using it, and we have it all in our products now because basically it's my thing. And the bottom line is that's a natural place where the indices come down and rest within our style, and it works for stocks as well. The exponential just puts more weight on the recent action. That's what you want for a moving average that other people aren't using. If you're using a 200-day, a 40-week, a 50-day, a 10-week, or 10-day, you want to use simple because you want to see what everyone else is using. And because you want to see, is it getting support where other people think it's getting support?
Because I was going to ask, do you use 50 simple? So that makes sense.
Yes.
You use simple for the 50 and 200.
Exactly. Anything.
So, what do you have on your charts? 21?
Yes, 21 exponential, 50, and a 200.
What about like an Adams pitchfork or like a Ichimoku cloud or all that other stuff?
You're trying to get me to cuss is what you're. No.
I just hit a nice button here. That's great.
That's a whole nother thing. So anyways, but I do use candles, but I can't use that in our products yet. But so I use
candlesticks.
Oh yeah, always use.
Okay.
It would give me the hardest time, but we'd be up on stage and we get a question. What do you think about candles, Bill? And he'd be like, I don't know. Webster uses it, and then I'd have to answer the question.
You're the stepchild. He doesn't want to talk about it.
Exactly.
Yeah, over there.
He's the only one in the building who uses it. But anyways, with this, going back to the stock, notice how every time it got down to that green line, the 21-day exponential, it got support. And this last time, you had that nice upside reversal there. It's gone over here and it has been tight. The only thing I'm not crazy about is the relative strength line is coming down a little bit, but a lot better than AMD, which was coming down substantially. So that's my take on this, and I added a little bit.
This is what Irusha was talking about. AMD like exploded after the follow-through day, and then just sideways. But it did get tight. It got super tight the last few days.
Exactly.
That was my best trade of the day today.
It makes sense. Yeah. Let me show Tom one thing that he might not. Go back to NVIDIA for 1 second. Tom, you were talking about
for Christ's sake. I'm kidding.
You were talking about funds, mutual funds. If you open up the right-hand side panel, Joe, and go to ownership.
This is where Arusha's like Batman pulling out his
I don't know why. Click on the owner. Click on the ownership.
Why is this taking? Okay.
Yeah, I don't know. You're making us look bad, Joe.
No, it's my internet connection. It's my AOL dial-up takes a while, so blame it on me.
Well, so basically, you're in the same birth year as the MarketSmith product is. You guys are both about 20 years behind.
There we go.
Fine. Not a big deal.
I love it.
One is timeless. One is timeless. I won't let you know which one it is. But
so this is the number of funds here?
You have 8 quarters, but then right below it, we added this maybe a couple of months ago. So it's not just the funds number that we're interested in. We want to know which mutual funds are buying it. And so these are part of the IBD Mutual Fund Index. And so there are 20 funds at the IBD Markets team. They select those fund managers. And Mike's already mentioned ContraFund, Will Danoff.
He's the best out there. Like
he's the best
there's
out
just
there,
no
right?
one better than. He might not always have the best return, but he's got so much money, and he's, I've never met the guy. I would love to meet him. He's a freaking genius. If you study what he owns, what he doesn't own.
I've heard, yeah.
Yeah.
Yeah. So we look for, we're looking for two or three funds in this list. So if Fidelity ContraFund's in it, that's a big plus.
I know.
Because, what
do you do with 50, 60, 80 billion anyways? I don't even know what,
I don't know.
You know what sucks is your universe.
NVIDIA.
Your universe of stocks
Yeah.
is the S&P 100. Like, I don't need to look at Magellan or ContraFund to know when I look at their top 10 holdings, it will be Apple, Amazon, ExxonMobil, Microsoft. Like, no shit, I know what they are because they can't buy an EVER because if they take a position in it, they're going to own the whole company. So,
but Joe, what you do is you look at these big ones like this, and then you see, look, they all have to, whether it's consciously or subconsciously, closet index to a certain extent. Because if they don't own NVIDIA and everyone else, all their competitors do, they're essentially short it. So they have to at least be market neutral on it, right?
Good point.
So what they're, put yourself in their shoes is like, okay, that's where they're going to get their alpha. So you want to look for where is it overweight versus the S&P. That's key. And then the other thing is, what do they own that's not in the S&P? Because that's what they're really reaching out and they're taking risk if they don't own it. If their bogey is the S&P 500 and they go out to an EVER, that's saying something. They're making a statement there. If they own a bunch of Apple, NVIDIA, Microsoft, they have to, like you said.
Yeah. That's a great point because I remember some hedge funds when Alibaba got public and it wasn't in the S&P 500 to pick up that alpha. They all plowed into it because one, it was liquid, and two, it was a way to, have something not correlated to the S&P.
Yeah, get some juice.
And a lot of them are doing an awful lot of sector buying instead because they can't. I mean, EV, like if you go back to if diversified, what was it, diversified insurance or something like that. They have to like the sector to get excited about a stock because they can overweight that stock, but they can't buy enough of it for what Joe said. They have to buy the whole company for any kind of significant move in that stock to make a difference to their portfolio. So the way that they do that is that they have to pour into its competitors as well. So they're making a sector decision a lot of times more than a specific stock decision, and then they're weighting those stocks inside of a sector decision.
So
exactly.
No, that's a great point.
Which
Mike,
is why I study the 197 industry groups, and I want to be part of the industry
in the top sectors. Yeah,
the top 30 or 40 industry groups, and I love seeing that industry group that's climbing in rank.
Yeah,
kind of that stealth move. I love seeing that.
The question I have is, so if O'Neill had this like incredibly like Rain Man skill to pick stocks and plow into like just like one name. My question to you is, did you pick up on like 2 or 3 secrets of what he used, like nuances to figure out? I know, Irusha, you said, he may be tasked with a whole bunch of stuff, but did you pick up any sort of nuances of what led him into that name?
Yeah. And it's a lot.
Can you share them?
It's going to make you guys happy because there's a lot of what you guys talk about. And I've watched all of your rants. I love them. I'm such a huge fan. I just want to say that. And I thank you guys so much for having us on the show. It's just,
thank you.
It's
awesome.
It's a ball. And I wish we hadn't been like plugging stuff. That was not our intent.
No,
I don't get a dime.
I want to get into the psychology though.
I want to plug more. So Mike,
well, you might get a dime. I don't. Give me a dime, and then I'll.
Yeah.
So look, I plug something if I'm a fan of it. So go get an AC/DC album. So
right.
To answer your question, and I saw it in real time, he wouldn't necessarily know that much about the stock that when he would buy it. But if he bought the stock and it was working, then what he would do, and by working meaning not testing the 10-week, because he didn't really use daily charts for individual stocks. He used daily charts for the indexes, but not for individual stocks. So if it was holding the 10-week, He's just gradually increasing his position. And as it's doing that, if it's holding the 10-week for the first move, then he's researching it and learning. What most people do is when they're down on a stock, then they're like, oh, I want to learn about it. I want to listen to a conference call. I'm down 15%.
Conference call, get on a
It's
chat
like,
room.
give me a break, man. But he would learn if it was working, then what would happen is, let's say he started with 8 stocks or 6 stocks. He would slowly sell off stocks. And I call it a source of funds. You're looking for your lower quality stock to sell to buy into your best one. And it was over time. And one of the last times, I kind of had a conversation with him. I was like, why have I not been able to do what he's done as far as just plow into a stock 200% long and ride it for the whole move? And he said, the key that most people don't get is you don't do it quickly. You do it over time and you focus on your cushion. And so that's where the weekly comes into play. He would look at interdays. He'd call me up and say, Mike, look at the 5 minute on this. He was reading the tape, but he wasn't making his big decisions off that. He was using the weeklies. And so he would learn about the company. Did it have a moat around it? Who was the CEO? He'd get to know that. He would have our teams write about them, the IBD writers write stories about them. And that's really what IBD was or is. It was just a hobby shop for him to do the research. He wasn't reading broker reports, never saw him do that, but he would have them write a story so he could understand, hey, this is what eBay does. It's a garage sale online and it's helping out all these people, and then just keep building and building the position. And no one could read a weekly chart the way he could. So he would see when there's danger ahead. And so a lot of it was going back to why you guys would like it. It was price action. Like, price doesn't lie. If the stock wasn't acting right, it didn't matter if he fell in love with it. He just out it went. So he could hold his winners, and that's a hard thing to do when you're piled into a stock. At least for me, it is. It's very difficult.
Mike, quickly talk about how Bill would analyze like a weekly chart, a weekly base, because that was one of the most priceless things, watching him do that in presentations and things like that. He would go bar by bar on the weekly chart and look at every bar. Okay, where's the volume? How did it close that week? That's the key. That's the kind of detail that
break down every weekly bar.
Yeah.
Pull up any stock, and we'll go through it, because you're right. And we did so many projects together on this where we would just plan out, like, if this happened, it's a +1. If this happens, it's a -1. And
I'll pull up like a Microsoft Weekly.
Sure. Yeah. Okay, so what you're doing is, when you're looking at a base, you're starting with your first week down off your closing high. So look at that most recent cup.
Like here or here?
No, let's go this one. Yeah, that one there.
Okay, that one.
So that's the beginning of your base. And as you go through it, it would be really helpful. I know MarketSmith has annotation tools, but I don't really like them. So I would print it off, and I would take 2 colored pens. I would take a red pen and a blue pen. And anything that you see positive, mark it up with a red pen. Anything negative, mark it up with a blue pen. Now, he didn't do the different color pens, but that's what worked for me for how he would analyze this. So the first week down, what is it telling you?
It's down on lighter volume than the previous week, but it's still holding its 10-week.
Okay. So exactly. So it's no big deal. So you don't even have to mark it with a pen, because it's just a down week, a bottom closing week. So no big deal. Now the next week, what does that week tell you?
It broke below the 10-week on some pretty heavy volume. So it lost institutional support, and it was huge distribution.
Put the track price on there, and let's look at the closing range.
You might need to turn on the pattern recognition too.
Yeah. Oh, yeah, you do for that. I forgot for that.
So yeah, when you turn on the pattern recognition.
No, but here's the track price.
So okay, do you see where it says closing range? So what that is within the bar itself, from the high to the low, if the bar is at 100, at the top, it's going to register as 100 closing range. If it's at the bottom, it's 0.
The range of the whole bar.
The range of the bar. So where that hash mark is, where did it close?
44%. Okay.
Yeah, and so the studies were that if it was 40% or higher on a down week, that was actually supporting action. So at first glance, you look at that and you're like, "Oh my God, that's."
I'm writing that down.
That's and what he would call it, and it was heavy volume without further price progress on the downside, and so that's a down week with 40% or higher, sometimes 38, but really 40%. So now you're marking that with a blue pen because you're saying, wow, this is actually good. It's support. And so what that means is by the end of the week, the big funds are in there supporting it because they've got hundreds of thousands or millions of shares and they can't go to cash. Which stocks do they want to hold and which ones do they not want to? Now we go to the next week. We won't go
really
through the whole
quick. Does breaking through the 10-week negate all that? Does it matter like where in other words, it's below the 10-week, it's lost support?
Yes and no. Toggle over, just pull up the NASDAQ composite real quick, 0 NDQC.
Comp, okay.
And look what happened that week. So you're always looking
29% in range.
Yeah.
So relative to that, Microsoft was better.
Always relative. Now, if let's go back to Microsoft.
And 40 or higher was good. Intuitively, I would think 50 or 70 or higher would be like a cutoff, but what the hell do I know? But 40 or higher was good. I
mean, that is something that he started coming up with probably before the two of us were born. All of us were born.
Okay.
So the next week, and we'll just do 2 weeks, and then you'll get the picture. This week, what do you guys think about it? Tom, how does that week look to you?
That's an inside week. This the third week, right?
Mm-hmm.
Right here, Tom. Yeah, that's what we're doing.
It's an inside week. It looks like it's below 40% though, because it closes right at the exact same point. So for me, I don't like it. That's a more negative bar to me than the preceding bar, simply because it's closing lower in the range. It looked like it tried to bust up through the high. It failed. It came all the way down, and now it's just kind of settling. I'd want to look inside the daily to kind of get an understanding a little bit more what that bar looks like, but that's just my personal opinion, having those two bars and it not being able to recover in any sort of meaningful fashion.
So yeah, we're somewhere in here, right?
So, and this is what's great about chart reading, because it's an art and everyone's going to see it differently. And I'll just tell you how Bill would see it and how I see it, is that the fact that it closed almost unchanged from week to week was a sign of accumulation. What you pointed out, the fact that it was an inside week was a sign of accumulation, because what it's saying is there's no new price discovery there, that it's not going to a higher low. It's within it, and the big players, always just put yourself in the mindset of the guys and girls running 50, 100 billion. What are they doing?
They're holding the line.
They're not letting
tight week on lighter volume than the previous week.
Yeah. So you do that throughout the rest of the base. If we did it for the rest of the base, we would be here until midnight. So that's his.
We might be here till midnight anyway at the rate we're going.
So that's the week by week.
Tom's heating up dinner and he's set a smoke.
Arusha asked me. He knew what he was setting me up
that
for
was
this.
a mistake. But,
that was a setup.
No, that's okay.
I want to get into the detail he's looking at. That's
awesome, because I don't look at any of that shit.
Yeah.
I love you, man. That's great.
I just look at it and go, nah, I don't like it. But it's because you've looked at so many patterns over so many years, and you just kind of
you're breaking down every weekly bar.
But for those small amount, right? So he's going through tons, or all of us were going through tons. Yes, no, yes, kind of like what Tom is talking about. But now when you come with those handful of charts, now you're looking more at the details and trying to grade them, like Mike has been talking
about. Mike, you make a great point, because they can't go to cash. So whereas a smaller player, we can, where because they can't, you're getting a feel for what they're holding on to, what they're supporting, and what they're what they're not getting rid of.
And it's more important with the big liquid names. That's why I was saying there's a difference with the EVER and a Microsoft, because you've got different players in there, and like what Tom was saying earlier, like they can't make a meaningful position there. They're playing the whole group, so they might not be in there supporting it.
Okay, so I want to get into psychology and music really quick before we finish, but I want to do one more chart, because now I want to pick your brain. One of our friends did a stock picking contest, and you picked DXCM.
Let me first extend an apology to all the ADD people like me out there who've been with us for an hour and a half.
I'm sorry, man. I babble on, dude.
This is like
Dude,
every
we're
day
all
when we're in the
talking. You're not
office.
talking any
Yeah.
more than anybody else.
This is like IBD Live with swears in it. It's perfect. That's all we're
Holy
doing.
smokes.
So really quick. So DXCM, I just want to pick your brain. Like you gave this, I think you said you were deciding between this one and Tesla. Is that correct?
Yeah, and I chose it correctly, and I own both of them. But you know, it really when you're picking for a contest like that, the cheesy way to do it, in my opinion, would be to and I got a lot of flack for it, was just pick a $5 biotech that maybe you get lucky on.
You're going. Yeah, it's a contest. You're going for the moon, but you're talking about. Let's just say you're picking it from a institutional point of view. Obviously, it's got the great earnings and sales growth. Obviously, we're all stuck at home shoveling food in our face and going to die of diabetes. So I get why, diabetes is big. But
look at those numbers, people. Look at those. Those are so sexy.
This is a $35 billion market cap company. Anyways, I'm asking Mike. Go ahead. Sorry.
No, so the point is, let's go to the weekly and to what Tom was saying.
I keep forgetting you go to weekly.
It's about the numbers and like exactly what he was saying. And it's also about the concept of they are the leader in their space. And that goes to your other question about, what was unique about Bill, so in picking the right stock, there's Tandem, there's Pod, and there's this one. And we know that this one was the best one for the year. But at the beginning of the year, I was just putting my Bill hat on and saying from that mindset, what would be, the best one, the quality one. And then there was, then the Tesla was my other one, but that one carries so much more risk. It's almost binary. It was going to be the biggest one or thing was going to flop. And so this was
more of a responsible institutional pick.
Yeah, and look, it's picture perfect the way it's come
it trades
down.
more responsibly, quite honestly. I mean, I mean, it's not.
Do you trade this, Tom? Do you trade Dexcom?
Some. I've been in and out of it a couple of times.
What did you trade today? I'm curious.
AMD.
AMD. I actually traded Love.
Oh wow! Let's pull that up.
I just played. All I did was play the earnings.
Oh, LOV. I pulled up Southwest Airlines.
LOVE.
Okay.
Who's Irusha talking to? See, he's got people that are waiting for him too.
I tell you, girls want to be with him.
More pressured now.
He's having text. He's like, I'm sick of you guys. I'm texting all these.
It was just
getting yelled.
They had good earnings. They've got good sales growth. They were getting gapped up. It's a thin stock. You could tell it was going to do a lot of volume today. Just based on the way a lot of the other ones went, I waited for it to pull back into the old high. I had some orders in there, and
so let's go to the interday on that, so you can walk us through your thought process, because I'm very interested in how you would have played that.
Here's the 5 minutes starting the day.
Draw a line across the old high of yesterday's high.
Okay,
gotcha.
So that's kind of my over/under limit. And
makes sense.
There's sort of what I'm looking at, and I was watching it pre-market, and it was up in the 21, even got up as high as 22 and a half, I think. And so I'm kind of like, okay, so it's already been there, and typically they want to at least run back up there and see what's there once the market opens. So I'd like to be able to see if I can catch this under 21 with a stop around 20, just to be safe. And I started buying shares. I had some orders stacked in there that got filled.
So you're breaking up your orders over time on the in and the out.
Yes.
Like, so what percent?
I'm taking it on the way down about half, and then when I see that it turns and it takes out the open. It's not it's
so this is Tom's 102,000 shares on that block right there.
Yeah. Okay. I want to see it take out the open, and then as soon as it took out the open, I bought another chunk.
Okay.
And then it surged, and then I took 2/3 of it off on that bar up through 23 at about 20.
I like that a lot. Yeah.
You took off into that. Okay.
Yeah, and then I just held, and then it formed
a
really
nice
pattern.
consolidation.
And so I added back, and then it surged up through 25. I took some more off, and then I actually got a little bit more. The rest of it out around 27, and then I just said good enough.
Did you revisit it later in the day or no?
I did not. I saw it later in the day. You see those two little highs there underneath 25.
underneath 24.
Yeah, I see
Oh,
it. Yeah,
right
that's
here.
it.
It was trying to come through again.
But it was in the middle of the market day. I didn't like the way the futures were acting quite as much, and
Nice
it never
trade.
broke through it. So I was kind of waiting to see if it plowed through those two, and it didn't. So what is this, a 5 minute or?
It's a 5 minute, yeah.
Yeah.
5 minute, yeah.
And so,
So I think that's beautiful, Tom, and that just goes to show there's so many different ways to trade. So day traders get a bad rap. You're reducing your risk. At the end of the day, you don't have any gap down risk. You can go home and
none.
do whatever you
Zero.
want. You
And
know,
so
it
that
doesn't
was
matter.
kind of my
Rant.
that was sort of my specialty play of the day, and everything else was AMD was a huge position for me. DraftKings was I played that early, and Love, and those were my three really big ones. Go back to that Love chart real quick, 1 second.
Yeah,
'cause
sure.
I can show you the stuff that it is just.
And I
And
want
it's
to,
the last thing
I want to
that
get
I'll
it.
say. I
No
want it
problem.
on
I
the
want to
5
get into the
minute.
psychology just because I know you have to
Yeah.
run. So,
But I want you to see those. I
5
want
minute.
you. The trading could be as simple as this. Like I don't need any moving averages or anything. You draw a line straight across from that early high at around 24. No,
Mhm.
up on the
Up
chart.
Here,
yeah.
here.
Draw it right around there. Keep drawing it. Keep drawing that bitch. There you go, all the way across. Okay, so that early high, once it explodes and gets clear distance away from it, first test of that level almost always gets a response. You don't know how big the response is, but it always gets a response. And it's a great trade. It's a great trade. Look at it. It bounced. It was probably 50 to 75 cents in a matter of 2 minutes. And it's scalping to a certain degree, but a lot of times they will show that support. And so you look at it, and then now you find those two lows that are made right there. And then when it comes back up and tries to get through there again, now it's resistance. And so it just stop.
And then
it
just became resistance later in the day, and then
you look at NVIDIA on a daily on a 5 minute chart. There's the same stuff.
Yeah.
It's just a beautiful thing, like Mike said. It's just different time frame. That's all. It's
Netflix. One of my
fractal,
best
right?
trades of the
Everything's
quarter
fractal.
was in Netflix off of the daily chart that had the exact same setup. At like
Before I forget,
395. I mean, it was just came down. Boom,
Before I forget, sorry, Mike, is with the 10 week, would O'Neill take profits when it got extended? I know you talk about support on the 10 week.
No,
When it got
unless it was a climax. That's what separates him out from
That's
Irusha,
unbelievable.
from me, from everyone else, is that for that, anyone else that I've ever seen trade, and I've seen a lot of great traders, that he would let a freaking profit run. And then, they wouldn't all work out if it ended up closing below the 10-week line.
So like
that's where
a Twilio, like this is the 10 week here.
he wouldn't be trading it. I'm trading
I know.
it, but he wouldn't
Okay,
be.
but I'm just saying, like when it just gets so, like there's just a huge visually, I call it visually extended. You can use Fibonacci's, whatever. Like he wouldn't take, just hypothetically, if this was a eBay, he wouldn't take profits when it got.
No, because see, we have these very specific rules called climax rules, and that happens when you're 18 weeks out of
I'm not
a
supposed to make a
base.
joke on that right now.
There's
I should
definitely a
not
climax.
touch that.
There's such
correct?
a climax.
I just want to
See, this is why Tom and I are a great team, because you
just
said
wanna make
Where we
sure
get in
that
trouble, Mike.
I-
This is where we get in trouble.
out of respect for MarketSmith and IBD,
You said
that I should
climax,
not
and Tom and I
make
instantly turned
any
into
kind of
12-year-olds.
gestures.
We instantly turned into juveniles because he's like, it's like Beavis and Butthead. He said climax.
Oh God!
It's like-
I haven't thought of climax that way in like 20 years. Okay.
And that's your problem, Mike.
Right. And Tom and I are 12 years old. So go ahead.
We're both both so there. We're knee deep in it.
So anyways, the thing is, we have very specific rules, and that's not in a position to use them, and because it's very early on in a move. And so
Okay.
what happens is a climax is what happens after a stock has been running for a while, then gets overheated.
Third,
And it's
fourth
the same-
stage climax.
And the same thing that what Tom is looking at on an intraday, I could see someone saying, well, why are you looking at a 5-minute chart? He would call me up and say, hey, Mike, pull up the 5-minute chart. Not acting on it. He's tape reading, just like Livermore,
Right.
the greatest of all time was tape reading. Doesn't mean you have to act on it. It means you're getting that feedback and saying, is my stock acting right or not? Tom is acting on it and taking a little bit here, a little bit there, and not holding it overnight. And we're looking at it saying, hey, is this acting right or not?
All right, that's cool. All right, well, I want to close with psychology because Tom will definitely love this
Arusha
part.
is going to get yanked. I can feel it.
I gotta
someone
go
right
too.
there.
Yeah.
No, we got to run really quick. Or you want to talk about that? You want to save it for another time?
We can talk psychology another time. I mean,
Okay, because this will
I'm
open up a
all
whole
7 other episodes that pretty much, rip the shit out of psychology and kind of cover a lot of things.
I know.
Yeah.
We can get into that.
And just so you know, I'm going out to my favorite Mexican restaurant now that's been closed during this whole time, and this is their
Nice.
first opening. So
Oh.
I've been polite, Arusha. I've seen you.
Arusha's like texting.
Arusha.
Where are you going? I might join you there. Where are you going?
Oh, this is tape. So the Riviera Mexican in Redondo, it's the best. Best salsa.
All your fans are going to be there.
Arusha, do you live near Mike?
Yeah, we live pretty close.
Okay, cool.
Yeah.
All right.
Awesome.
You're
Hey,
not
all right. So
coming, dude.
we'll save the
Unless you
music.
buy margaritas.
We'll save the music. We'll save the psychology. For another time because I can't tell you how much we appreciate this because I'm sitting here taking notes. So I don't care if anyone else liked this because I'm taking notes. So it's all about.
Thanks
me.
for having us. It was
awesome,
an
man.
honor.
So
We'll do it
Thank you.
again.
Yeah.
Maybe we do it once a month or something where we just go over
Yeah,
all
we can look
kinds
at
of
more
shit.
charts.
Yeah.
We can look
This
at more
is great.
charts next time. I want Mike to pull up his charts next time because I'm more
watch
interested.
the master.
You're asking me what I like. I'm like, what do you care what I like? I want to know what you like.
Because then they can be TradeStation charts, and we can work on trying to get a sponsorship from TradeStation. See if we can
Look,
spin
TradeStation
that.
is a great platform. I've been using it for since 1998, and I couldn't trade without our stuff and that's more of searching for stocks and reading the weekly charts. But for monitoring throughout the day, I can't live without TradeStation, and they don't pay me a dime either.
No.
There you go. Guys, I can't thank you enough. I've learned a lot. It's been a lot of fun. We definitely have to do this again soon.
All right.
That was great. Thanks for having me.
Thanks, man.
Hey, thanks, guys.
Great seeing
Can we
you,
play
boys.
the music on the way out?
Yeah, play the music on the way out.
On the
Finish
way
us up.
out.
Wrap us up.
On
Get
the
us
way
some
out.
closure, baby. Come on.
All right, here we go.
There it is.
There we go.
We got a second.
God, that sounds horrible, man.
Thanks, guys.
All right, thanks.
All right, see you guys.
See you.